everyone. Let's begin now with Part 4 of our course. This part of the course provides an overview of adjustment items, itemized deductions, and credits. And detailed coverage of these subjects is provided in the following Pacific Northwest Tax School courses, including above-the-line deductions, deducting medical expenses, deducting taxes, interest, and charitable contributions, the foreign tax credit and other credits for individuals, and finally, tax credits for families with children. Let's begin with the first of these topics, which is adjustments to income. These are commonly referred to as above-the-line deductions. And let me get over here back onto the 1040 form where we can see the adjusted gross income section of Form 1040, also referred to as above-the-line deductions. Unlike itemized deductions, adjustments to income can be claimed in addition to your standard deduction. Now, the IRS requires that our annual federal tax refresher course cover only 3 of the adjustment to income items, including the deductible part of self-employment tax, the student loan interest deduction, and the tuition and fees deduction. If you want to learn about any of the other deductions shown in the adjustment to income section, you should complete our course called Above the Line Deductions. Let us now look at the first of the required components, the deductible part of self-employment tax. If you are self-employed and you owe self-employment tax, you will complete Schedule SE to figure the amount of self-employment tax you owe and the deductible part of your self-employment tax. If you completed Section A of Schedule SE, the deductible part of your self-employment tax is shown on line 6 right here. But if you completed Section B of Schedule SE, the deductible part is shown on line 13. Student loan interest deduction. Certain individuals who have paid interest on qualified education loans may claim an adjustment to income deduction for interest expenses of up to $2,500 per year. The deduction phases out when income exceeds $65,000 to $80,000 per year for single filers and twice that amount if you are filing a joint return. The phase-out limit is shown here based on your filing status. If you are single, head of household, or qualifying widow, and your modified adjusted gross income is not more than $65,000, then your student loan deduction is not affected by the phase-out. But if your income is more than $65,000 and less than $80,000, you will be allowed a partial deduction, and when your income hits $80,000, you are allowed no deduction at all. And of course, those same rules apply with higher thresholds for joint filers. And the final adjustment item we're looking at is the tuition and fees deduction. It was extended through 2014, but is now expired for 2015, unless it is extended by future legislation. For 2014 and earlier years, you are allowed to deduct up to $4,000 as an adjustment to income if your AGI is $65,000 or less if you are single, or $130,000 or less if you are a joint filer. And you are allowed to claim a $2,000 deduction if your AGI is $80,000 or less, or $160,000 or less for joint filers. Of course, you had to have qualifying educational expenses in order to claim the deduction, and the expense must be not less than the deduction claimed. Coordination with other tax benefits. If you, your spouse, or your dependent incurred qualifying educational expenses, you may also qualify for the Lifetime Learning Credit or the American Opportunity Credit if you meet the test to claim those credits. If you qualify for more than one benefit, you should claim the deduction or credit which reduces your tax the most. You can claim only one of the available benefits for any student, but if you have more than one student, you can claim a different benefit for the other student. And let's talk now about the standard deduction, because we've finished already those few adjustment items that the IRS wanted us to cover in today's class. So we're now moving over to page 2 of the Form 1040, and we're getting over to line 40, where you enter either your itemized deduction or your standard deduction. And for 2015, the standard deduction amounts are as follows. For single filers, $6,300. The additional standard deduction amount allowed if you are blind or age 65 or older is $1,550. For head of household, the standard deduction amount is $9,250. For married filing joint and qualifying widow filers, the standard deduction is $12,600. And if you are filing a separate return, it is $6,350. Also, for married filers, the additional standard deduction for being blind or age 65 or older is $1,250. That's $300 less than if you are single. You are not allowed to claim the standard deduction, and you must itemize your deductions if You are married filing a separate return and your spouse itemizes his or her deductions. You are filing a tax return for a short tax year because of a change in your annual accounting method, or you are a non-resident or dual status alien during the year. You are considered a dual status alien if you were both a non-resident and a resident alien during the year. And remember, the standard deduction for dependents, you have to basically do a formula to determine what the standard deduction of a dependent is, but it is typically going to be the greater of $1,050 or $350 plus their earned income for the year. But the standard deduction for a dependent can never exceed the standard deduction for a non-dependent. Itemized deductions. If you're not claiming the standard deduction, it's probably because you're itemizing, so let's take a look at some of the itemized deduction points that the IRS wants you to know about. With few exceptions, the IRS permits most taxpayers to claim a standard deduction or to itemize their deductions. You can benefit by itemizing your deductions if doing so reduces your tax. If you itemize, you will not be allowed to claim the standard deduction. In addition, if you are required to itemize deductions, additionally, you may be required to itemize deductions if you are filing separately from your spouse and your spouse itemizes on his or her return. Now, the IRS Federal Tax Refresher course does not require that we cover all elements of Schedule A. They specifically require only the highlighted areas. And so those are the areas we're going to cover today, including taxes you paid, interest you paid, and gifts to charity. The other items shown on Schedule A are not covered. You can take other areas in our course called Deducting Medical Expenses, Deductible Taxes, Interest, and Charitable Contributions. We also have a course on casualty losses and a course on employee business expenses and other miscellaneous itemized deductions. That's where you can go to learn about the other parts of Schedule A. Let's talk now about deductible taxes. You may be able to claim a deduction for certain taxes you paid on Schedule A on lines 5 through 9. And for a tax to be deductible, it must meet two tests. The tax, firstly, must be imposed upon you, and the tax must be paid by you during the year. To be imposed on you, the tax must be imposed on your income or on property you own. And taxes you pay on property that you do not own generally are not deductible. To be considered paid by you, assuming you are a cash basis taxpayer, and nearly everyone is, you must pay the tax during the year for which you are filing the return. For example, a tax is imposed but not paid. If the tax is imposed on you in 2015, but you do not pay it until January of 2016, you cannot claim a deduction for it on your 2015 return, but you will be able to claim a deduction for the tax on your 2016 return. Income taxes. Schedule A, line 5A. You may deduct the following income taxes that you paid: state and local income taxes that are withheld from your wages during the year. State and local estimated taxes paid during the year can be deducted if you reasonably believe you needed to make the payments. A refund of state tax you choose to have credited to next year's estimated tax. State or local government balance due income tax payments you paid during the year, and mandatory contributions to state benefit funds withheld from your wages that are provide protection against loss of wages. One such example is California's SDI tax. Deduction for sales tax paid, claimed on Schedule A, line 5B. The deduction for state and local taxes is a temporary deduction that was brought into law during the Bush administration. The Tax Increase Prevention Act of 2014 extended the deduction through 2014, but it is now expired for 2015 unless it is extended by future legislation. You may be able to claim a deduction for sales tax you paid. This deduction is taken instead of the deduction for state income taxes as follows. If you elect to deduct income taxes, you will check box A on line 5 of Schedule A and then enter the amount of state and local income taxes that you are deducting. But if you elect to deduct sales tax, you will check box B instead, and then you will claim a deduction for the sales tax you paid using one of two methods. Under Method 1, you will use the actual amount of state and local sales taxes that you paid to calculate the actual sales tax deduction you are allowed to claim. And under Method 2, you will complete the state and local general sales tax deduction worksheet using the optional state sales tax tables. In our course under Deductible Taxes, Interest, and Charitable Contributions, we have a couple of illustrations on how to complete those sales tax deduction worksheets and compute the sales tax deduction. But in today's class, we're just going to move on to the discussion of real estate taxes. You may claim a deduction for taxes imposed on real property that you own, provided the taxes are assessed based on the value of your property, they are levied for public welfare, The tax is imposed upon property you own, and the tax must have been paid by you. Taxes assessed to improve the value of your property are not deductible. For example, assessment that improves the value of property. You are levered $2,500 to pay for sewer connections to your home because this levy is to improve your home. No deduction is allowed. Proration of taxes on purchase or sale of property. Because you can only claim a deduction for taxes assessed on property for the period of time you actually own it, you should review settlement statements for tax prorations between the buyer and the seller when you buy or sell your home. And here is an example where tax proration is required. You buy a new home in October of 2015. In November 2015, you receive your annual property tax assessment showing $2,000 as your July 2015 through June 2016 property tax levy. You will be the owner of your home for 9 out of the 12 months in that assessment period. For the portion of the assessment period that you were not the owner, which is July, August, and September, you must prorate your deduction to include only the portion of tax actually assessed while you are the owner of the property. Assuming you pay the assessed tax in full before the end of the year, you can claim a deduction for 9/12 times $2,000, $1,500, which is 75% of the tax amount owed. And here is an illustration where we figure the seller's part of property taxes. In November 2014, little Jimmy paid $2,592 of taxes due on his home for an assessment period of July 1, 2014 through June 30, 2015, and then he deducted the taxes on his 2014 Schedule A for Form 1040. Then on April 28, 2015, Bimbo and Betty Boop purchased the home from little Jimmy, and the settlement statement for this transaction is shown next. So we can see here that the settlement date is April 28, 2015. We can see here that there is a county tax proration going on for the period of time after Bimbo and Betty Boop purchased the house. And it shows that the proration amount for the period of April 28, 2015 through July 1, 2015 is $454. Because the home sold partway through the fiscal year, that is the July 2014 through June 30, 2015 assessment period, the settlement statement shows that $454 as an adjustment item to the seller on line 107 right here. That $454 represents the amount of tax assessed for the 64 days in the assessment period that fall after little Jimmy sold his home. Since little Jimmy claimed a deduction for these taxes on his 2014 return, the $454 amount is a taxable refund that Jimmy must report as income on line 10 of his 2015 tax return. For Bimbo and Betty Boop, however, things work a little bit differently. Property taxes assessed for that fiscal year, July of 2014 through June of 2015, were paid in full in November of 2014. The seller is due a refund of the amount and has to include it in his income, but the buyers are going to be allowed to claim a deduction for that $454 amount on their 2015 return. And here is another illustration. We're going to assume all of the same facts as in illustration number 1, except little Jimmy decided to pay his 2014 through 15 property tax assessment in 3 equal installments rather than all at once in November. And he paid the installments as follows. He made one payment of $864 in November of 2014. He made another payment of $864 in February of 2015. And then he made a third payment on April of 2015. Because little Jimmy paid only 1/3 of his taxes in 2014, his deduction for taxes claimed on his 2014 Schedule A was limited to $864. And since little Jimmy paid the remaining amount, $1,728 in 2014, he will be able to claim a deduction in 2015 for the $1,275 portion of the $1,728 that is attributable to when he owned the home. So he'll essentially take $1,728, subtract out the portion that is going to transfer over to the new owners, and deduct the difference. And little Jimmy will be able to claim that $1,274 as taxes paid on his 2015 Schedule A. And of course, in the next illustration, we're showing that Bimbo and Betty Boop paid that $454 as the buyer's share of property taxes on the purchase of their new home. Then in November of 2015, they received the property tax statement assessing taxes for the period of July 1, 2015 through June 30, 2016. The Boops pay that amount in full in November of 2015, and that means when they file their 2016 2015 return, on Schedule A, they will be able to claim a deduction of a full $3,104. That will include the $454 they paid at close, plus the additional $2,650 they paid in November. Let's look now to some real estate-related items that you cannot deduct. Payments for the following items generally are not deductible as real estate taxes. Taxes for local benefits, itemized charges for services such as trash and garbage pickup, transfer taxes or stamp fees, rent increases due to higher real estate taxes, and homeowners association charges. Taxes for local benefits. Taxes assessed for local benefits and improvements that improve the value of your property also are not deductible, and examples of improvement assessments include street paving or improvements, sidewalks, water mains, sewer lines, parking facilities, and similar improvements. You should increase the basis of your property by the amount of any such assessment. Local benefit taxes are deductible only if they are for maintenance, repair, or interest charges related to these benefits. And if only a part of the taxes is for maintenance, repair, or interest, you must be able to show the amount of that part to claim your deduction. If you cannot determine what part of the tax is for maintenance, repair, or interest, then none of it is deductible. And next we're going to look at personal property taxes. These are claimed on Schedule A, line 7. Most states impose personal property tax on cars. If you paid personal property tax on your car or on other properties such as a boat, RV, or airplane, you may claim the tax you paid as an itemized deduction. To be deductible, the tax must be charged on personal property based only on the value of property and charged on a yearly basis, even if it is collected more than once per year. Fees you pay for licensing or registration of your vehicle that are not based on the value of your vehicle are not deductible. And now we're on to deductible interest. And most forms of personal non-business interest payments are not deductible. But there is an exception for certain home mortgage interest payments and investment interest, and that's what we're going to look at here. Home mortgage interest, if you are claiming a deduction for home mortgage interest, it can be claimed on one of three lines, depending on the type that it is, line 10, 11, or 12 of Schedule A. Interest you pay on a loan that is secured by your main home or your second home is home mortgage interest. You must meet these tests to claim a deduction for the mortgage interest that you paid. You must be legally liable for the loan, and there must be a true debtor-creditor relationship between you and the lender. The mortgage must be a secured debt with your home offered as collateral for the loan. For secured debt, you can deduct your home mortgage interest only if your mortgage is a secured debt. A secured debt is one in which you sign an instrument such as a mortgage deed or trust or a loan contract that makes your ownership in a qualifying home security for the debt, provides in case of default that your home could satisfy that debt, and it is recorded or is otherwise perfected under any state or local law that applies. In summary, your mortgage is a secured debt if your home is used as collateral to protect the interests of the lender, and if you cannot pay the debt, your home can then serve as payment to the lender to satisfy or pay that debt. When is debt not secured by the home? Well, debt is not secured by your home if it is secured solely because of a lien on your general assets, or if it is a security interest that attaches to the property without your consent, such as a mechanic's lien or a judgment lien. A debt is not secured by your home if it once was, but is no longer secured by your home. Home mortgage interest that you would report on line 10 of Schedule A. If you paid mortgage interest during the year, you should receive Form 1098 Mortgage Interest Statement. Form 1098 is generally issued when you pay your mortgage to a person or organization where the loan is considered to be part of a business operation. And you would report mortgage interest that is shown on Form 1098 on line 10 of Schedule A. Now, there are other kinds of mortgage interest that do not get reported on line 10, and one of these is mortgage interest that is not reported on a 1098. If you pay your mortgage directly to the seller, you are paying a seller-financed mortgage, and generally you will not receive a 1098 mortgage statement and must provide additional information about the lender on Schedule A. If you are paying your mortgage as a seller-financed mortgage, you do not receive Form 1098, you must do the following. Report the amount of interest you paid to the seller on line 11 of Schedule A, and then in the space provided on line 11, provide the payee's name, Social Security or EIN, and the address. And here we have a quick illustration where we can show on line 11 that the payee is Wilma Deering. We've entered an identification number for her and her address, and then the amount of mortgage interest that was paid to her during the year. Points can be entered on either lines 10 or 12 of Schedule A, and points are a form of prepaid interest. Generally, you must amortize points you pay over the life of the loan. There is an exception, though, where points can be fully deductible in the year paid if you meet the following tests. Your loan is secured by your main home. Paying points is customary in the area where you live. The points charged were not more than points generally charged in your area. You used the cash method of accounting. The points were not a substitute for other common closing costs. The funds you provided at closing were at least as much as the points charged. You used your loan to buy or build your main home. The points were computed as a percentage of the principal amount of the mortgage, and the amount is clearly shown on your closing or settlement papers. If you meet all of these tests, you can choose to deduct points paid in the year you pay them, or you may amortize them over the life of your loan. For refinancing, the following rules apply to points paid on a refinance of your home mortgage. Generally, you must amortize points you pay to refinance, even if the new mortgage is secured by your main home. If you amortize points, you can claim a deduction for points as a prorated amount each year, and if you pay your mortgage off early, you should still claim a deduction for all remaining unclaimed points in the year that you pay off that loan. And now we're going to move on to charitable contributions. These items are claimed on lines 16 through 18 of Schedule A. And the first rule with claiming a deduction for a contribution to charity is that it must be made to a qualifying organization. You can deduct your contributions to charity only if you make them to a qualifying organization, and to become qualified, an organization must generally apply for nonprofit status with the IRS. An organization other than a church or government organization must apply to the IRS to become a qualified organization. And you can use the following resources to determine if an organization is a qualified organization. You can begin by asking the organization, because if it is a qualifying organization, it knows it and it will tell you. Or you can go to the IRS website with the link that we have here and use the online tool to search for qualified organizations. And as a final resort, you can call the IRS and ask them. Contributions from which you benefit. You cannot claim a deduction for a contribution you make to an organization to the extent that you benefit from that contribution. And here's an example where you are only allowed a partial deduction because you purchased an item. You purchased 2 tickets at a charity auction, and the tickets are valued at $100, but you pay $150. You will be allowed to claim a charitable deduction of $50. Membership or dues paid to qualified organizations. You can deduct the cost of membership fees that are $75 or less. You can deduct a larger amount only to the extent that you do not receive additional benefits solely because of the higher dues. If you pay extra to receive extra benefits, you must subtract the value of those benefits from your charitable deduction. You can pay more than $75 and receive a deduction of more than $75 as long as you do not receive additional benefits that are not available at the lower membership cost. And here we have an example where a membership fee is deductible. You attain a family membership to the zoo for $74 a year. Even though you are entitled to free admission to the zoo with your membership, because the cost of the membership is $75 or less, you can claim a deduction for the membership fee. And we are, of course, assuming this is a 501c3 or a government organization, right? Example number 2, membership fee is greater than $75, but it's still deductible. You obtain a membership at a rate of $500 because you are a special sponsor. You gain additional privileges of little or nominal value, and that means that even though you paid more than $75, you will be allowed to claim that $500 deduction for your contribution to the zoo. You should get a written statement if the payments for benefit are greater than $75, and generally the charitable organization you donate to is required to give you a written receipt that breaks down the amount of your contribution from the value of the benefits that you receive. Certain exceptions do apply, and you can read Publication 17, pages 161 to 62 for more on that. Volunteer expenses. You can deduct expenses you paid to provide volunteer services to a qualified organization. To qualify, the expenses that you pay must be unreimbursed, directly connected to the services, expenses you had only because of the services, and are not personal or family expenses. Conventions. If you are a chosen representative of the qualified organization, you can deduct your travel and meal expenses directly relating to your official duties for the organization. But again, you cannot deduct the cost of personal activities or the cost of bringing family members with you. Uniforms. The cost of uniforms you must wear while performing donated services and which are unsuitable for personal use can be deducted. Foster parents. If you care for a child placed with you by a qualified organization, you may be able to deduct expenses that are unreimbursed out-of-pocket expenses to feed, clothe, and care for the foster child, and mainly to benefit the qualified organization. Transportation. You can deduct auto expenses you incur while providing volunteer services to a qualified organization. You must keep written records to prove the expenses. Allowable auto expenses can include the actual cost of gas and oil, or a standard mileage rate of 14 cents per mile, and you can deduct the cost of parking and tolls. You cannot deduct the cost of driving to church unless you go to church on official business as a volunteer. For travel, you may be able to deduct travel expenses you incur while providing volunteer services to a qualified organization, subject to the following conditions. Number one, you must be performing services for the qualified organization, and there can be no significant element of personal pleasure, and the trip must be substantially for duties that you are performing for the organization. If you have only nominal duties, or if significant portions of your time are not spent performing your duties, you cannot claim charitable deduction for your travel expenses. Exchange students. You can deduct expenses you paid for students living with you under a written agreement with a qualified organization, subject to the following limits and conditions. You must be able to claim a deduction of up to $50 per month per student enrolled in grades 12 or lower. The student cannot be related to you. The student cannot be your dependent. The student must be attending school full-time, that is 15 or more days in the month claimed, and you cannot deduct the cost of a foreign student living in your home under a mutual exchange agreement in which your child goes to live with a foreign family. Cash contributions. You cannot deduct a cash contribution regardless of the amount unless you have a record such as a canceled check or bank statement showing the name of the charity, amount and date, or a written communication from the charity. Items purchased from a charitable organization. An item you purchased from a charitable organization is deductible only to the extent that you paid more for the item than its value. So, for example, if you make a donation to public television and in exchange for that they give you a DVD of a movie valued at $20, your deduction will be limited to the $80 difference. Non-cash contributions. These are entered on Schedule A, line 17. To figure how much you may deduct for property that you contribute, you must first determine its fair market value on the date of the contribution. You generally can claim a deduction for the lesser of the fair market value of an item you donate or your cost basis in the item. And determining fair market value, well, fair market value is the price that the property would sell for on the open market. It is the price that would be agreed upon between a willing buyer and a willing seller, with neither being required to act, and both having reasonable knowledge of the relevant facts. For used clothing and household goods, generally the fair market value of these items is much less than you paid for them. As a guideline for valuing these items, you can go to IRS Publication 561. You can visit a local resale store. Also, the amounts that items sell for at Goodwill or Salvation Army can be a good guide. For boats, aircraft, and cars, if you donate a vehicle to a qualified organization after December 31, 2005, your deduction is limited to the gross proceeds from its sale by the organization. This rule applies if the claimed value of the donated vehicle is more than $500. However, you generally can deduct its fair market value if the organization makes significant intervening use of the vehicle, materially improves the vehicle, or transfers the vehicle to a needy individual in direct furtherance of the donee's charitable purpose of relieving the poor and distressed or underprivileged who are in need of a means of transportation. These rules apply to donations of boats, aircraft, and any vehicle manufactured mainly for use on public streets, roads, and highways. Form 1098-C, you cannot claim any deduction above $500 for a donated vehicle, boat, or plane unless the recipient charity provides an acknowledgement on Form 1098-C, which must be attached to your return. If you did not receive Form 1098-C, you cannot deduct more than $500 for your contribution. And Form 8283, total non-cash deductions. What happens when they exceed $500? There's some more rules in place for that as well. If your total non-cash contributions for the year totaled more than $500, you must maintain all records required for donations of $250 or more, plus you must complete and file Form 8283 with your federal return. On Form 8283, you must provide the name and address of the charitable organization and a written description of the items that you donated that includes their cost to you and their fair market value on the date that you donated them. You should note that this rule applies whenever total non-cash contributions exceed $500 and not just when a single contribution exceeds $500. And here is an illustration. where Form 8283 is required. You donate used furniture to Habitat for Humanity. The fair market value of the furniture is $450. Then 2 months later, you donate books with a fair market value of $50 to the county library and $200 of used clothing to Goodwill. Even though no one contribution exceeds $500, all three charities must be separately listed on Form 8283 because the combined total of all non-cash contributions is greater than $500. The furniture of $450, the books of $50, the clothing of $200, all total $700. That's more than $500, so the form must be completed. You provide the date acquired and the date donated, how you acquired the property, the cost basis that you have in the property, the fair market value of the property. You describe the method by which you determined the fair market value, and then you also provide the name of the charity and a description of the items donated. Exemption amount, we're finished with itemized deductions. We're now going to move on to line 42 of the Form 1040 form. You are allowed to claim a deduction of $4,000 for each exemption you entered on line 6 of Form 1040. That is simply saying that if we go back up to the Form 1040, whatever number you have entered here, you're going to multiply that by $4,000 to figure your exemption deduction, unless you earn too much money. And if you earn too much money, then you are subject to a phase-out. And the phase-out will essentially reduce the amount of the exemption that you're ultimately allowed to claim. There is a worksheet to figure that exemption, and if your income is in the range shown here, then you would be subject to a phase-out. If your income is higher than the amount shown for the phase-out completed, then you're not allowed an exemption deduction at all and would enter 0 on the line. Credits. Credits are a reduction of tax rather than a reduction of taxable income. So we're on to this section right here where we've got the foreign tax credit all the way through the other credits line. Most credits are non-refundable, which means they benefit you only to the extent of tax shown on line 47, that's this line right here, of the 1040. But a few credits can be refunded. Refundable credits are treated as payments and therefore can be used to increase a client's refund even when they are more than the tax owed. If you are eligible for a refundable credit, those credits are shown here under the payments section. Refundable credits are going to be covered a little bit later in our class today. So for now, we're going to look at lines 49, 50, 51, and 52. Our course will cover these credits, and if you want to learn more about these credits, you can take our course called Foreign Tax Credit and Other Credits for Individuals, as well as Tax Credits for Families with Children. The first credit in line we are exploring is the Child and Dependent Care Credit. The Child and Dependent Care Credit relates specifically and only to the cost of paying for child care. It is meant to help reduce, or child care or adult care for a person who cannot care for themselves. It is meant to help reduce taxes for families that pay child or dependent care costs so that the parent can go to work. The credit also applies to taxpayers who are married or have a dependent who is mentally or physically incapable of self-care. You can claim this credit only if you work or are looking for work, or if you are a student. And if you are married, your spouse must also work or be a student, unless he or she is incapable of self-care. You may only claim the credit for a qualifying person who lived with you during the year. If you are separated from your spouse, you can only claim the credit if you were the custodial parent during the year. There are some tests to claim the credit. The first test is the qualifying person test. You must file Form 2441 with either Form 1040 or 1040A, and on the form you must identify the person who qualifies you for the credit. You must provide the name and Social Security number or ITIN of each qualifying person. To qualify you for the credit, the person must be one of the following: your dependent who was under age 13 when the care was provided and for whom you can claim a dependency exemption. There is an exception. You are the custodial parent of your child for whom you cannot claim a dependency exemption because of a divorce or separation decree, or because you signed Form 8332, Release of Claim to Exemption of Divorced or Separated Parents, or a similar statement in which you agree not to claim your child's exemption for the year. Your spouse who was physically or mentally not able to care for himself and who lived with you for more than half the year, or your dependent who is physically or mentally incapable of self-care and for whom you claim a dependency exemption, or could claim the individual as a dependent except their income was above the exemption amount for the year. That was $39.50 for 2014, and it's $4,000 for 2015. Test number 2, Earned Income Test. You and your spouse, unless either of you were physically or mentally incapable of self-care, or either of you were students, must have included income during the year. For purposes of this test, earned income includes wages, salaries, tips, and employee compensation. Self-employment income, but a net self-employment loss will decrease earned income. Non-taxed earned income, such as parsonage allowances, meals and lodging furnished for the convenience of the employer, voluntary salary deferrals, military basic quarters, and combat pay. But earned income does not include Social Security, pension or annuities, investment income, scholarship income, unemployment, or workers' compensation. There are special rules for if you have a student or a disabled spouse. Your spouse is considered to have earned income in any months that he or she was a full-time student or is physically or mentally incapable of self-care. Your spouse must also live with you for more than half the year. Test number 3 is the work-related expense test. You must pay the child and dependent care costs to enable you to work for pay or look for work. If you did not work for the entire year, you must include only expenses you paid while you are working or looking for work. Payments to relatives. You must make payments for child or dependent care to someone you cannot claim as a dependent. If you paid your non-dependent child for the care, then the child must be age 19 or older by the end of the year. Test number 5 is the joint return test. You cannot claim the credit if your filing status is married filing separate. All other filing statuses are eligible to claim the credit. If you are married, you must file a joint return to claim the credit unless you meet the filing status test for being considered unmarried and then use the head of household filing status. So what does considered unmarried mean? To qualify for head of household status, just as a reminder, because we covered it earlier today already, you must be either unmarried or considered unmarried on the last day of the year. And you are considered to be unmarried on the last day of the year if you meet the following tests. You file a separate return. You paid more than half the cost of keeping up your home for the year. Your spouse did not live with you in your home during the last 6 months of the year. And for more than half the year, your home was the main home for your child, stepchild, or foster child, and you must be able to claim that child's exemption. Test number 6 is the provider identification test. You must identify the person or business that you pay to provide care, and you must provide the following information for each provider: their name, address, and Social Security number. But if you are unable to obtain this information, you may still be able to claim the expense under the due diligence procedures shown here. Test number 7 is the employer paid expenses test. You must reduce your credit by any amount of dependent care expenses that your employer paid for you or which you had withheld from your pay tax-free. Dependent care amounts include amounts that your employer pays for the qualifying person or the fair market value of free care that you receive in a daycare that is provided by your employer. Your salary may have been reduced to show these benefits, and if you receive these benefits, they should be reported in Box 10 of Form W-2. Earned income limits. The amount of work-related expense you claim cannot be more than your earned income for the year if you are single at the end of the year, or the smaller of you or your spouse's earned income for the year if you are married at the end of the year. But for each month that you are married and your spouse was not working, but they were a student or were incapable of self-care, this is a month where your spouse will be treated as having earned income. For each such month, your spouse will be considered to have $250 of earned income if there is one qualifying person, and $500 if there are 2 or more qualifying persons. Dollar limit. The maximum amount of dependent care expense you can claim for the credit is $3,000 for one child or one qualifying person, and $6,000 if there are 2 or more qualifying persons. To calculate the credit, complete Form 2441. Your credit is a percentage of your allowable expense. The percentage varies between 35% and 20% of your AGI, and the minimum amount of the credit is 20% when your AGI exceeds $43,000. To claim the credit, complete Form 2441 and then enter the credit on Form 1040, line 49. The child and dependent care credit is non-refundable. This means it can reduce your tax to 0, but if your credit is greater than your tax, the difference cannot be refunded to you, and it also does not carry forward. Next up, we're looking at line 50, which is the rules for education credits. And there are 2 kinds of education credits that are available to taxpayers. There's the American Opportunity Credit and the Lifetime Learning Credit. The American Opportunity Credit provides a larger maximum credit amount, but it is available only to certain degree candidates. The Lifetime Learning Credit is available for a broader range of educational courses. However, the maximum amount of the credit and the income phase-out level for the Lifetime Learning Credit is less than for the American Opportunity Credit. The American Opportunity Credit, as it sits today, has been extended all the way through 2017. These are the rules in place from now through 2017. It was first introduced in 2009, and it provides a credit of up to $2,500 of the cost of tuition and related expenses paid during the taxable year to a qualified educational organization. The credit is 100% of the first $2,000 of tuition and related expenses and 25% of the next $2,000 of tuition and related expenses. 60% of the calculated credit is non-refundable and 40% is refundable. The credit is subject to a phase-out when adjusted gross income exceeds $80,000 or $160,000 for married filers. The credit can be claimed by a non-dependent taxpayer student, a dependent student whose parents do not claim that child's dependency exemption, and by a parent or other individual who claims a qualifying student as a dependent. What are the tests to claim the credit? Well, generally you can claim the American Opportunity Credit if all three of the following requirements are met. You paid the qualified education expenses of higher education. You pay the education expenses for an eligible student, and the eligible student is yourself, your spouse, or a dependent for whom you can claim an exemption on your tax return. You should note that qualified education expenses paid by a dependent for which you claim an exemption or by a third party for that dependent are treated as though they were paid by you. Eligible students, to claim the American Opportunity Credit, the student for whom you paid qualified educational expenses has to be an eligible student, and this is a student who meets all of the following requirements. The student did not have any expenses that were used to figure the American Opportunity Credit in any 4 earlier years. This includes any year where the Hope Credit was claimed for that same student. Also, the student must not have completed the first 4 years of post-secondary education. That typically means they don't hold a bachelor degree. And for at least one academic period beginning in 2015, the student was enrolled at least half-time in a program leading to a degree, certificate, or other recognized educational credential, and the student has not been convicted of any federal or state felony for possessing or distributing a controlled substance as of the end of the year. Let's talk about the refundable part of the American Opportunity Credit, because 40% of the credit can be refundable for most taxpayers. However, you cannot claim any part of the American Opportunity Credit as a refundable credit if you are under age 24 at the end of the year, and the following applies to you. You were either under age 18 at the end of 2015 or age 18 at the end of 2015, and your earned income, defined below, was less than 1/2 of your support, or a full-time student over the age of 18 and under the age of 24 at the end of the year, and your earned income was less than 1/2 of your support, and at least one of your parents was alive at the end of the year, and you are filing as single, head of household, qualifying widow, or married filing separately for the year. Earned income includes such things as wages, salaries, tips, and other taxable employee pay, net earnings from self-employment, and the gross income received as a statutory employee. Support. Your support includes all amounts spent to provide you with food, lodging, clothing, education, medical and dental care, recreation, transportation, and similar necessities. To figure your support, count support provided by you, your parents, and others. However, a scholarship received by you is not considered to be support if you are a full-time student. Next up, we have the Lifetime Learning Credit. You may be able to claim a Lifetime Learning Credit of up to $2,000 for qualified educational expenses paid for all eligible students enrolled in eligible educational institutions during the year. The Lifetime Learning Credit is generally smaller and less advantageous than the American Opportunity Credit. However, it is also less restrictive in that it can be used to pay the costs of post-secondary education and may also be claimed where a student is not enrolled in a degree program. Benefits of the Lifetime Learning Credit. Well, there is no limit on the number of years that this credit can be claimed for each student. However, a taxpayer cannot claim the American Opportunity Credit and the Lifetime Learning Credit for the same student in the same year. Thus, the Lifetime Learning Credit can be particularly helpful to graduate students, students who are taking only one course, and those who are not pursuing a degree. Who can claim the credit? Well, generally you can claim the credit if all three of the following requirements are met. You paid qualified education expenses of higher education. You pay the education expenses for an eligible student, and the eligible student is yourself, your spouse, or a dependent for which you claim an exemption on your return. If you're eligible to claim the Lifetime Learning Credit and are also eligible to claim the American Opportunity Credit for the same student, you can choose to claim either but never both. You can pay qualified education expenses for more than one student in the same year and then choose to take the credit on a per student per year basis. This means, for example, that you can claim the American Opportunity Credit for one student and then use the Lifetime Learning Credit for another student in the same year. The Lifetime Learning Credit does have phase-outs, $54,000 to $64,000 for single head of household or qualifying widow, and $108,000 to $128,000 for married filing joint, but no credit is allowed if your filing status is married filing separate. Here is the form that you need to complete if you are claiming either the American Opportunity Credit or the Lifetime Learning Credit. You complete Part 1 to figure the refundable part of the American Opportunity Credit. You complete Part 2 to figure the non-refundable education credit. And then in Part 3, you provide information for each eligible student that you are using to claim the American Opportunity Credits. Password number 4 is KIWI, K-I-W-I. KIWI. Next credit we're going to look at in line is the Retirement Savings Contribution Credit. This credit is designed to encourage low and middle income filers to invest more for their retirement. The credit varies from a low of 10% to a high of 50% of the amount that you invest in your retirement account or IRA. You can contribute to your IRA up until the due date for your return, not including extensions, and then still claim this credit. You qualify for the credit if all of the following is true. Your AGI is not more than the amount shown for your filing status. For single, married filing separate, and qualifying widow, that amount is $30,000. For head of household, it's $45,000, and for joint filers, it's $60,000. Also, the contributions to your IRA or employer-sponsored retirement plan must be greater than certain taxable or non-taxable distributions that you have taken from your IRA or retirement plan between January 1, 2013 and the due date, including extensions of your 2015 return. Also, you must have been born before January 1, 1998. That means you are at least 18 years old. You are not claimed as a dependent on another person's return, and you are not a full-time student for 5 months or more during the year. Distributions which will reduce the qualifying amount of your contribution. Distributions from the following kinds of accounts which you or your spouse, if filing jointly, received after 2012 but before the due date of your 2015 return, including extensions, will reduce the amount of the contribution you are treated as having made for the year. Roth IRAs, 401k, 403b, 457, SEP and Simple plans, and qualified retirement savings plans as defined in Section 4974. Distributions which do not reduce the amount of qualifying contributions. Distributions which do not reduce the amount of qualifying contributions. The amount you use to determine the credit is not reduced by the following events related to your retirement account. Distributions not taxable as the result of a rollover or a trustee-to-trustee transfer. Distributions that are taxable as a result of an in-plan rollover to your designated Roth account. Distributions from your eligible retirement account other than a Roth IRA that are then rolled over or converted to your Roth IRA. Loans from a qualified employer plan that are treated as a distribution. Distributions of excess contributions or deferrals. Distributions of contributions made to an IRA during a tax year and then returned with any income allocable to such contributions on or before the due date of that return for that year. Distributions of dividends paid on stock held by an employee stock ownership plan. And distributions from a military retirement plan, as well as distributions from an inherited IRA by a non-spousal beneficiary. How you claim the credit? Well, you complete Form 8880 and then enter the amount of the credit on line 51 of the Form 1040. Your credit is based on the applicable percentage rate for your income level and filing status but cannot exceed your liability, or $1,000 or $2,000 if you're filing jointly, whichever is less, and you will use the following table to compute your credit. If your filing status is married filing joint, this is the phase-out range, and if it's head of household, this is the phase-out range, and then, of course, single filers are down here. So if your income, for example, is not over $36,000 and you are filing jointly, then the credit is 50% of your qualified contribution, not to exceed $2,000 for the year. If your income is over $39,000 but not $60,000 and you are filing a joint return, then the applicable percentage is 10%. These tables are indexed for inflation each year, and you're looking at a 2014 table here. Child tax credit. The child tax credit is an additional benefit that may be available to you if you are claiming an exemption deduction for your child. The child tax credit is tied to the dependency exemption for your child, and unlike the child independent care credit, can be claimed by a non-custodial parent. Qualifying child. To claim the child tax credit, you must have a qualifying child whom you claim as a dependent on your tax return. The definition of a qualifying child for purposes of the child tax credit is similar, but not identical to, the definition of qualifying child for purposes of determining dependency. Qualifying child is defined for the child tax credit. A qualifying child for the child tax credit is all of the following: your son, daughter, stepdaughter, foster child, brother, sister, stepbrother, stepsister, or descendant of any of them, for example, your grandchild, niece, or nephew, and is under age 17 at the end of the year, did not provide more than half of his or her own support, lived with you for more than half the year, is claimed as a dependent on your return, does not file a joint return for the year, and was a U.S. citizen, U.S. national, or a U.S. resident alien. Here is an overview of the rules for claiming a dependent, which are not the same. They can be similar, but not the same as the rules for the child tax credit. We covered these rules at the beginning of our course when we did those flow charts for claiming a qualifying child and claiming a qualifying relative, and at that time I told you that the IRS had a table that they now use instead of flow charts. This is the table. Table 3.1, we've pulled it from IRS Publication 17 on page 27, and it shows the test for being a qualifying child, the test for being a qualifying relative. In order to claim the child tax credit, you must have a qualifying child, and then in addition to having a qualifying child, the qualifying child must also meet these additional tests that relate to the child tax credit. Death or birth of the child. If your child was born or died during the year and your home was that child's main home for more than half the year that while he or she was alive, then your child is considered to have lived with you for more than half the year. Temporary absences. If your child lived with you or did not live with you because of special circumstances, such as they went away to school, they were on vacation, they were away on business, had to receive medical care, were in the military, or even if they were detained at a juvenile facility, that time away from home is considered to be time that they actually lived with you. Dependents with items. If you are claiming a child tax credit or an additional child tax credit for a child identified on your return with an ITIN instead of a Social Security number or with an adoption identification number, then you must complete Part 1 of Schedule 8812. Part 1 asks you a question about each qualifying child to verify that the child was in fact a U.S. citizen, national, or was a resident of the United States. There were problems with people claiming the child tax credit for children living in Mexico, and that is not allowed. What is the amount of the credit? Well, the maximum child tax credit that you can claim is the lesser of your federal tax liability after certain credits, or $1,000 for each qualifying child. If your credit is limited because your tax is less than your credit, you may qualify for the refundable additional child tax credit. Income limits on the child tax credit. If your modified AGI is above the amount shown below for your filing status, your child tax credit will be reduced or eliminated as shown in the following table. And how much or little child tax credit you're going to be able to claim really is dependent on the number of children you have. Your income can be higher and still receive some child tax credit if you have multiple children as opposed to only one child. Modified AGI. For purposes of the child tax credit, your modified AGI is your AGI plus the following amounts. Any amount you excluded from income under the exclusion rules for income from Puerto Rico or under the foreign earned income exclusion or because you were a resident of Samoa. If you do not have any of the above, then your modified AGI and your AGI are the same. Additional child tax credit. Well, the additional child tax credit is a refundable credit. It is entered on line 67 of the return if you are allowed to claim it. The child tax credit is non-refundable and can reduce your tax, and the child tax credit is claimed up here on line 52. But if the child tax credit is more than your tax, you may be entitled to the additional child tax credit down here. And how do you go about figuring the amount of your additional child tax credit? Well, there are two different methods for calculating the amount of additional child tax credit that you are allowed to claim. If you qualify for both methods, you should choose the method which gives you the largest credit. There are rules for claiming the credit with one or more qualifying children, and to qualify for the additional child tax credit, you must meet all of the following rules. You have one or more qualifying children for whom you claim a dependency exemption. You have more than $3,000 of earned income. You have no federal income tax liability showing on line 56 of your federal return. In other words, line 56 is 0, and you complete and attach Schedule 8812 to your return. Now, even if your earned income was less than $3,000, you may still qualify for the additional child tax credit if you have 3 or more children. And if that's the case, these rules apply to you. You must meet all of the following rules to qualify for the additional child tax credit if you figure it in Part 2 of Form 8812. or now it's Schedule 8812. You have 3 or more qualifying children. You owe no federal tax. You complete Schedule 8812 Part 2, and you must have paid Social Security and Medicare tax or Social Security or self-employment tax if you are self-employed. How to calculate the credit? Figure the credit on 8812, then carry the allowable credit to line 67 of the Form 1040, but you can also enter it on line 43 if you were filing short Form 1040A. So that completes Part 4 of today's class. It's now time to pause the video, take some review questions, and when you are ready, you can resume playback with Part 5.